In today's episode, we're going to look back at how previous bear markets dropped and how the cycles play out. Second, we'll talk about bear market survival strategies and break down the macro news factors behind a key question. Many of you are asking, the US government reopened, that should be bullish, so why did crypto prices still fall?
Today is November 17th, and the Fear and Greed Index just plunged into extreme fear, sitting at 9. Levels this low haven't been seen since major market capitulations in recent years. Looking back on June 18th, 2022, the index hit 6, one of the lowest points ever. Bitcoin was trading around $20,000 at the time. That wave of extreme fear came after BTC dropped from the 2021 bull run top near $68,500, and then it spent almost a year and a half moving sideways between $20,000 and $30,000. It eventually broke out in late 2023 and climbed all the way to the 2025 high of $120,000. Let's take a look at past cycle tops and drawdowns. Back in April 2021, Bitcoin dropped about 57%. But that wasn't a full-blown bear market. It bounced back and hit a new all-time high near $69,000 in November. After that peak, the real bear market began. Bitcoin fell all the way back to around $20,000, a maximum drop of roughly 77% over more than 700 days, a really long cycle. Now let's compare that to the drawdowns after 2024. From January to April 2025, BTC went from $108,000 down to $75,000, a drop of 32%. The current retracement is from $125,000 to about $94,000, a 25% decline. The duration of these recent corrections has been much shorter. Drops are faster and smaller, which suggests the market structure may have changed. So the big question is, are we entering a true bear market now, or is this just another mid-cycle flush before the next leg up? Some traders believe Bitcoin may already be entering an early-stage bear market and that the classic 4-year cycle might be breaking. One sign, several older altcoins suddenly had explosive moves recently. Projects like ZEC, FIL, ICP, and others. Historically, this kind of last party for legacy alts often happens toward the end of a bull market, not the start of a new one. However, this bear phase might be shorter than past cycles because U.S. equities may move into an AI-driven liquidity cycle, pushing more money into tech and risk assets. The key factor we must watch is liquidity. Right now, U.S. liquidity is tight due to government shutdown effects, ongoing Fed balance, sheet reduction. So far, RRP spread near crisis levels. Even though the government reopened, markets did not bounce, which means liquidity has not recovered yet. The next major macro trigger to watch is the December FOMC meeting. If the Fed pauses QT or signals rate cuts, liquidity could improve, but it would still be normalization, not full stimulus. A true big liquidity wave might not come until after May next year, depending on U.S. political and Federal Reserve leadership changes. So what can we do now? Remember the bear market survival principles. First and foremost, protect your capital. That's the foundation for everything else. Next, when fear is high and prices are near key support levels, scale in slowly. Don't go all in at once. Use a DCA approach, buying in over time to manage risk. Focus on strong assets with clear narratives. Avoid chasing hype or short-term fads that can swing wildly. And finally, stay patient. Sideways accumulation and consolidation often create the best entry points for the next big move. From November 8th to the 14th, the total crypto market cap fell from $3.66 trillion to $3.38 trillion, over an 8% drop. This was one of the roughest weeks since March. Bitcoin slipped below $100,000, with more than $1.1 billion in liquidations, mostly from long positions. Looking at the sector performance, Layer 1 tokens dropped 4.8%, DeFi fell 5.4%, and meme coins lost about 4.85%. One rare bright spot was TON, which rose over 10%. The RSI fell to 37.3, signaling that the market could be oversold and setting the stage for a potential rebound. So why did crypto sell off even after some good news? Let's break it down in simple terms. First, weak US economic data. The outlook for jobs, inflation, and consumer spending worsened and markets turned risk-off. Second, 10-year Treasury yields climbed to around 4.1%. Higher yields mean higher discount rates, which pushes down valuations for tech and crypto. Third, there are AI bubble concerns. Some AI companies reported disappointing results, and a lack of transparency in their financials created uncertainty for investors. Finally, the US government shutdown caused a data blackout. Many important economic indicators, including CPI, were delayed or distorted. When investors don't have reliable data, they naturally reduce risk. The same thing happened after the FTX collapse. BTC went from $15,500 to $102,000 in the following cycle. So while the market feels heavy right now, this is actually when long-term investors start preparing, not panicking.
If there is a coin, sector, or strategy you want me to cover next time, leave a comment below. Stay calm, stay rational, and always protect your capital. See you in the next video. Bye for now.